Good morning and welcome to today's Essential Wisdom Series webinar made possible by Penn Mutual. This is Manal Haq, Marketing Coordinator for AALU. Today we welcome Lou Shuntich, Director at the Advanced Consulting Group with Nationwide Financial. He has published 5 books and numerous articles on advanced marketing subjects and previously served in the law department of a major life insurance company for 26 years, where he specialized in business insurance, estate planning, and compensation planning. Lou's topic today is succession planning for family businesses. As always, this webinar is meant to be interactive. I encourage everyone on the line to utilize the Q&A button on your control panel to submit any questions, which Lou will address at the end of the webinar. With that, I turn it over to you, Lou.
Thank you. Let's go to the next slide under agenda. Keep going. There we are. With regard to our agenda this morning, I'll begin by making some preliminary observations about the business insurance market, which I can tell you is quite an opportunity for us in the insurance business. Then I'll talk about the role of life insurance in succession planning. You'll find that whatever exit option someone chooses to take, life insurance has several preliminary needs that should be addressed. And those are the opportunities for us. Then I'll talk about the possible exit options that are available to business owners. After that, some tips on where you find prospects in this market. And then also I'll be talking about IRC Section 101J, which deals with requirements that have to be met when you have employer-owned life insurance if you want the death proceeds to be income tax-free. Next slide. Now, in terms of these preliminary observations I mentioned, we have found that family business owners really need help in understanding the kinds of exit options that are available to them. Now, ideally, this process for exiting a business should start 2 or 3 years ahead of time. Understand, this is not like selling a share of stock in a listed exchange where you just pick up the phone and call your broker. When you're talking about a closely held business, and especially a family business, this process should start, as I said, 2 or 3 years ahead of time, and it involves first packaging the business to make it appealing, and then finding a successor, and then finally actually making the transfer to them. All that takes time and planning. Now, as I mentioned, life insurance is and should be a preliminary consideration, whatever exit option the business owner chooses to take. And next, because you're dealing with a family business, it's important to focus on the impact this transfer of the business has on the entire family, and especially those who are going to be actively involved in the business. Next slide. Demographically, there was something like and because of these demographic figures, we find that there are probably 2 or 3 sellers for every qualified buyer to acquire one of these. But you better have. The problem is that only about 40% of these people have even talked to or spoken to a financial professional last year, which gives you some idea of how little they've done in the way of planning. Next slide. Now, we find from these statistics, the surveys, that there are about 25 million businesses in this country. 80% of those are closely held. And here's the kicker. 90 to 96% of those are family-owned businesses. And that's where your market is. Also understand that only about 1/3 of these businesses actually have a written succession plan, 2/3 don't. So that gives you some idea of how much of an open market there is from that kind of help we can give them. Next slide. Okay, I previously mentioned that life insurance should be a preliminary observation or concern when you're doing exit planning, regardless of which of the exit options you ultimately choose. And there are 5 of these insurance needs we're going to address this morning. The first one is to preserve the value and saleability of the business. The second is maintaining family harmony. Now, I'll tell you here that this is not to be underestimated. We know that when you're dealing with succession planning, it's not just the business which is at risk, it's also the family. Unless you pay attention to doing it properly, you can destroy your family. Next, we need to think about our employees, rewarding them and keeping them around through the transition to new owners. They add stability to the business, and it's necessary to keep them around. Insurance can play a role in that. Also, We have to make sure the business owner actually gets paid if it's a sale of the business we're dealing with. Insurance has a role in that. And finally, we want to use insurance to provide estate liquidity. Next slide. Here's a quotation from Andrew Carnegie, who was a very successful industrialist in the steel industry. He built and ultimately sold to J.P. Morgan what became U.S. Steel for like $480 million, which in today's world would be an astronomical number. So this is a person to be paid attention to when he says something. And he said here that you could take all his hard assets away, and if you left him his people, his key people, he'd have them back within a few years. I believe that. Next slide. Why? Well, it's not just talk to say in many situations, the most valuable asset in business is the key employees. And yet, while no business owner will open their door in the morning to do business without making sure they had insurance on the building, on the vehicles, liability insurance, what don't they insure? Many times they fail to insure the employees. And I leave it to your imagination what happens to the value and salability of the business if a key person dies. Obviously, it's hurt. Now, what they need to do then is estimate the amount of lost revenue and additional expenses they'll incur to find, hire, and train replacement, and then purchase life insurance to cover that lost revenue and additional expenses. Next slide. Here's an example. We've got an employee who's 45 years old and bringing in something like 25% of sales volume, or $500,000 a year. This person were to die, we're assuming that it would take 2 years to find, hire, and train a replacement to bring things back to normal, which means 2 years of lost revenue of $500,000 a year. That means they need at least $1 million insurance just to cover the lost revenue. On top of that, it's going to cost them $100,000 to find, hire, and train a replacement. Total tab, $1,100,000. And that's the amount of insurance that the business owner should require on this individual. Purchased by, owned by the business pays the premiums. Now, the premiums won't be deductible, but the death proceeds are income tax free to the business. Let's go to the next slide. Here's where it really gets interesting. We start talking about product choices. Let's assume we've got Joe working for us. He's 55 years old, and Joe plans to work until he's 65. Now, if we're going to buy key person insurance on Joe, the first thought that comes to mind with most people is, well, if Joe's going to work for another 10 years, let's buy a 10-year term policy. That can work. But a couple of cautions. First of all, if someone gets so sick it hurts so bad they can't work, in the old days, that meant they died pretty soon thereafter, and you would collect a death benefit. But in today's world, the medical science being the way it is, they can keep a terminally ill or injured employee alive for quite a while. The business, if this person's not working, can't afford to wait months or years for them to die to collect the death proceeds. They need the money right away. So what I'm suggesting here is, even if you buy just a term policy, make sure to buy an accelerated death benefit so the company can get the money quickly. Now, let's assume that Joe works for the 10 years from 55 to 65. He's alive at the time of retirement. What do we have to show for it? Well, we had 10 years of life insurance protection, but it's all gone. There's nothing now to show for what we paid. On the other hand, let's consider what happens if we buy a cash value policy. Number one, again, make sure that that cash value policy has an accelerated death benefit rider. But supposing they get too sick to work, but they're not going to die, what can we do about that? My suggestion is to consider also possibly buying a long-term care rider to attach to the policy. So there, even if they're not so sick to die and you can't collect the accelerated death benefit, you might be able to collect a long-term care benefit to offset the loss to the company because the person's not working. Going further, if you buy a cash value policy, at the end of the 10 years when Joe retires, that cash value policy gives us 4 options that term policy would not. First of all, let's suppose that Joe, while he was able to work to 65, developed a medical condition somewhere along the way, such that he'd like to have insurance for his family, but he can't afford it or can't get it. We could sell Joe the policy for its cash value. Be a good deal for Joe. Alternatively, if he's been a good employee, we like him, want to take care of him, we just might give him the policy as a supplemental retirement benefit, which he can access through loans and withdrawals going forward after retirement. Third, we might just surrender the policy and get all or portion of our money back as the employer. Or finally, just keep the policy in force till Joe dies, and collect the death benefit income tax-free. Next slide. Beside the possibility that Joe might die, if he's a good employee, there's also the risk that somebody might come along and hire Joe away, especially if Joe hears that the company is going to change hands. You know, people don't just sit around and wait to lose their jobs, knowing that a new owner comes in, they could be fired. So what you have to think about here is, what can you do to keep these key employees around once they learn they're going to transfer the business? What can you give them to make it appealing to stay? You need some kind of a golden handcuff, because they're staying with the business during the transition period is important to stability in the situation and the successful transfer of the business. So you think about some kind of a golden handcuff. Next slide. Now, I will tell you this. Every one of the examples I'm going to be giving you are based on real cases I've worked on over the years. So this is real world kind of examples. Here's a situation involving a construction company that I get involved with in Washington, D.C. The owner of this company had built quite a few federal buildings. He was quite wealthy and looking forward to retirement and wanted to get out in about 3 years. But he knew that if his 3 top construction bosses found out that he was going to sell the business, they would leave. Again, people don't sit around and wait to lose their jobs. So he needed something to keep them around. And in many people's minds, simple is good. And the simplest arrangement we could think of to make these people stay was called a restricted bonus arrangement. And in terms of the mechanics, on the next slide, we find that the way it works is the business pays the premiums on a policy that's applied for and owned by the employee. And the employee names the beneficiary, typically their family. These premiums are income taxable to the employee, like a bonus, and are deductible by the business. Now, to make it a golden handcuff, there's a separate written agreement between the employee and the business, where the employee agrees not to touch the cash via the policy until certain triggering events, such as in this case, the passage of 3 years or the sale of the business. In addition, in that separate agreement, we have the statement that if an employee leaves early, they have to pay back the premiums that the employer has paid on the policy. That's your golden handcuff, the obligation to pay back. Next slide. We find that when a business owner has a family, there are going to be situations where they may want to transfer the business to some member of the family, but not others. And what it comes down to is there are people who just don't have an interest in the family business, other situations where they shouldn't be involved. So parents typically want to take care of all their children. So one child, so to speak, gets the business, and the other child, what do they get? I think the best answer is to use life insurance to take care of them. This is the way of equalizing the inheritances to the children. Key point is that you don't have to give the same amount of insurance as via the business. So for example, let's say we transfer a business to a son that's worth $3 million. The daughter's a school teacher. She doesn't want to be involved. How much insurance do we have to give her? $3 million like divide the business? No. Why? Circumstances are different. The son's got to go to work every day. He doesn't do that, the business will fail. The daughter, on the other hand, is going to collect cash, income tax free. So perhaps a third or quarter divide the business would be fair to the daughter in the form of life insurance. Next slide. Here's an example of a case I get into where my former consulting partner and I were speaking to the North Tampa Chamber of Commerce. There were 28 people in the room. Again, all business people concerned about succession planning. And as Denny was speaking, we were taking turns. I noticed there was a couple sitting there in their mid-30s, and they were staring into space. They looked like they're caught in the headlights. What's going on here? After we finished speaking, I approached them. Turns out they were first cousins. And her parents had started a home inspection business here in Florida that was doing in excess of 4,000 home inspections a year. And the business employed 18 members of the family. Now, the reason they were staring into space was that her parents were in the mid-60s and still in good shape and able to run the business. But they both knew that eventually her parents would do one of 3 things. What all business owners eventually do, and that is die, retire, or become disabled. What then? The what then they both knew was that her brother would bully his way in and take over the business. This brother had been married and divorced 3 times and had serious drug and alcohol problems. If he took over the business as he would destroy the business and the family. I cannot tell you how many times over the years I've seen circumstances like this, these kinds of people. I think the best description about them I've ever heard was that the kind of people who are frequently wrong but never in doubt. Watch out for them. In this situation, fortunately, the parents were sensible about it. They recognized their son's shortcomings and what he would do to the business if he got it. And we worked out a situation where we did a buy and sell agreement between the parents and the daughter. So when they went out of the picture, under the terms of the buy and sell, she would take over. But what about the son? He was a pain in the neck, but he was still their son. The solution was for the parents to buy a second-and-die contract on themselves and make the son the beneficiary. So when they're gone, the daughter gets the business, he gets some cash to take care of him. Next slide. Income replacement. If a business changes hands, even if it stays in the family, because they're new owners, some of the employees, maybe members of the family, could lose their jobs. Remember, new owners want their own team. So what do you do about these people who lose their jobs? Can they find new jobs? Can they make the same kind of money as they did before? Possibly not. Consequently, it's a thought for the business owner to perhaps purchase an immediate deferred annuity for the people losing their jobs. Next slide. In this example, I knew of a woman who had a ranch. She owned it for 50 years. She enjoyed it, spent a lot of time there. One problem, after 50 years, she had gotten to the point where she couldn't enjoy it the way she had. For example, she could no longer ride her horse, at least not safely. So she knew she had to sell. Problem, her manager had worked for her for almost 40 years. And at his age and his stage, she was concerned he could not find another job, at least not making the kind of money she paid him. So what did she do? Took some of the proceeds for the sale of the ranch, and she bought him an immediate annuity. Didn't have to, but it was the right thing to do. Next slide. Certainty of payment. Even now, after we've had some recovery economically, the capital markets can still be tight, especially for somebody who's trying to buy a small business. So what does it mean? It means that oftentimes as people are selling these businesses, have to take installment notes. Anytime you take paper in payment, you're taking a risk you're not going to get paid, especially if the person dies. So to protect yourself in that way, the good idea is to insure the lives of the buyer, so if they happen to die, you collect the proceeds and you get paid. Next slide. Estate liquidity. Even if a person is able to sell their business for cash, does that mean they want that cash to be used in one way or another at their death to cover estate liquidity needs? Those liquidity needs can be for estate taxes, they can be for debts, credit cards, mortgage payments, who knows? Anyway, there's an interesting story about a guy that sounds kind of silly at first until you realize he was a top of the table producer year after year. He made a lot of money selling life insurance to business owners for succession planning. And what he would do was, as he approached them, he would give them a Tootsie Pop. And a natural reaction when an adult was given a Tootsie Pop is, why are you giving this to me? This is candy, it's for kids. He would say, no, listen to me, there's a serious side to this. You see, that Tootsie Pop is very much like your estate in terms of composition. The hard outer shell, the sucker part, that's like your illiquid assets, your real estate, even your business that may be hard to sell. That nice, soft, chewy center we all like, that's like your liquid assets, your cash, your marketable securities. You know, when you die, 9 months later, your executor's got to file an estate tax return and generally pay their tax at that point. Where are they going to find that kind of money in 9 months? Well, the answer is that the IRS is going to take that soft, chewy center, your marketable securities, your cash, liquid assets, gone, leaving the sucker, the hard part for your family. Well, as you can imagine, nobody likes the idea of being a sucker. He sold a lot of insurance that way to fund estate liquidity. Next slide. Here's an example of a person who's got a projected estate tax liability of $1 million, recognizing they want to be able to use other than their liquid assets to pay the tax. They set up a ILIT, irrevocable life insurance trust, with a lawyer. It doesn't cost that much. They make relatively modest gifts of cash to the trust. The trust uses that cash to buy life insurance. They go on living. When they die, the insurance covers the tax. Now, I'm going to tell you another story, because we could tell you something about how important insurance can be in these situations. Yes, I'm very much aware of the fact that the estate tax exemptions have reduced significantly the number of people who have to worry about an estate tax, but they're still out there. And even though Donald Trump has become now the president-elect, indications are that while he might eliminate the estate tax as we know it, he might just substitute a capital gain tax at death in its place. One way or another, with the government's need for money, I think we can pretty well be sure that some kind of a death tax or tax connected to death is going to be out there. So it's still important for us to think about that and plan for it. And there are certainly going to be clients to whom this is a concern. Here's my point. There are a number of ways that people can try to deal with estate taxes when they own a business. All those ways pretty much involve two things. You have to give away what you have to produce the size of your estate. And in doing that, they typically enter into some sophisticated planning techniques that allow them to discount the value of what they're giving away. Now, on this point, I'm also aware of the fact that the IRS has just released some proposed regulations under Section 2704 that would affect the discounts we can take on these transactions. Be aware of two things. First of all, those transactions or those regulations wouldn't take effect until after the first of the year. And secondly, the Trump administration is likely to eliminate those regulations so that this way of gifting at a discount, I think, is still a viable and good choice that's worthy of thinking of. We're going to get into that. But before we do it, let me share a story with you. My mother and father-in-law, they're both gone now, owned a large farm that straddled the Georgia-Florida border. And I knew, looking at the situation, they were like most farmers, land rich, cash poor, which meant that when they passed away, we were going to face an estate tax that would force us to sell a piece of the property to come up with the money, which of course nobody in the family would want to do. So I announced to the family that after my father-in-law's 80th birthday party, I was going to make a presentation on why and how we should establish a limited partnership to eliminate our estate tax exposure. So here we are, the party's over. He's 80 years old, mother-in-law is 78, sitting next to him. 3 daughters, including my wife and her husbands, including myself. My wife's aunt had a similar problem with the ranch. And just as I'm about to speak, my mother-in-law stands up and says, I have to get my hair done. And she blushes as she says this, which means she's uncomfortable. I'm kind of shocked by that because she knew I was going to speak about the subject of the limited partnership. And my father-in-law says to me, Lou, let her go, she'll come around. And eventually she did. But what was she saying to me? Was she telling me that she was worried about her hair or something else? I submit to very much something else. And something else was, I understand you're going to be telling me that I've got to form this partnership. I hear it's going to cost me $20,000, $30,000 to set up. Not only that, but if we put our farm into a partnership, that's going to change how we do our banking. It's going to change how we do our taxes. I'm 78 years old. I don't want to change. Not only that, but I understand I'm going to have to give these partnership shares to my daughters. What if one of them gets divorced due to a bad business deal? What happens to our farm? All these, you understand, are very rational, sensible kinds of questions that people are going to ask as they get older. Because as people get older, the one thing they don't like is change. So what's the alternative to engaging in these complicated and sophisticated transactions, which some people don't want to do? And the answer, if you're worried about estate tax liquidity, is life insurance. We're not going to ask you to change your life. You just go to your lawyer, and for a modest sum of money, you have a trust set up. Then you make relatively modest gifts of cash to that trust, which a trustee uses to buy life insurance. Go live your life as you always have. You pass away, the insurance will be there to pay the tax. Okay? Next slide. Here now we come to the subject of employer-owned life insurance and these new requirements in regard to notice and consent. The background for this is that some time back, you may recall that big corporations like Walmart were buying life insurance on the rank and file employees. In some cases, they weren't even telling the employees that they were buying the insurance. And then when the employee died, the company would collect the death proceeds, income tax-free, and give nothing to the person's family. This was considered to be offensive. In some cases, it was called janitor's insurance. I think the most offensive was called dead peasants insurance. Anyway, finding this to be inappropriate, unconscionable, Congress enacted Section 101J of the Code. And basically, Section 101J says, if you're going to insure an employee's life, there are certain conditions you have to meet. The death proceeds to be income tax-free. First among those, you have to give the employee written notice that you're going to insure the life and the maximum amount of insurance you're going to buy on them. Secondly, this employee has to give you, the employer, written consent to buy the insurance, and you must tell them that the employer is going to be the beneficiary of the coverage. Okay, next slide. Had they given the proper notice, receiving the consent for the employee to be insured, there are some additional requirements that have to be met in order for the death benefit to be income tax-free. The first of those requirements is that the employee insured be either a director or highly competent individual, or that they have been employed by the employer during the last 12 months. If they don't meet either of those two conditions, the death benefit is income tax-free to the extent it's actually paid to the employee's family as a benefit, or it's paid for their share of the business. Now we're looking at slides with regard to actual options for exiting the business. Which one is chosen, and we're going to be covering them, is going to depend on the personal business and financial goals of the business owner and the other stakeholders. So what's this word stakeholders? Essentially, what I'm getting to is that we need to think about not just the business owner and their family, but all the other people that could be affected by the transfer of the business, such as their employees, their customers, and their suppliers. The Japanese are very good at dealing with all these issues, all these other stakeholders. We are not. And I can assure you, when you're transferring a business, you need to think about the interests of these other people. If you don't, it can come back and bite you. Next slide. Okay. Among the transfer options available are a transfer to members of the family. Now here, as I've said before, it's critically important that we pay attention to the interests of the entire family, and especially those people who are going to be actually taking over the business or taking an active interest in it. And when we select the technique for transferring the business to these family members, we've got three possible choices. They're making an outright gift of it, making a gift of it in trust, or alternatively, selling the business to these family members. Next slide. We're looking first at the idea of making a gift. The first question I have to ask is, can this business owner actually afford to just give away the business interest to these family members? I say this because over the years that I've been doing this, I've seen situations where people, for whatever reason, it could be tax saving, whatever, they give away too much. And they find themselves in a situation where they don't have what they need to live, and then try and get it back. So my point is this: if you're going to give it away, make sure you can afford to do so. Secondly, if you're going to give it away, you have to think about the gift tax consequences of doing that. And if there are going to be gift tax consequences, then we need to think about these tools I've described earlier for gifting at a discount. And again, I'm aware, as I see, these regulations that are under 2704, but I'm skeptical and doubtful that they'll ever be applied. As a matter of fact, I'm not even quite sure what they mean at this point. But because, again, the Trump administration coming in, I don't think we'll see these having any effect. So they remain an important tool for us. Now, here's a caution. Sometimes when people have family members who want to be involved and take over the business, and others who do not or should not, they get ideas about giving those who won't be involved a passive interest in the business. For example, let's say a father's got two sons. One son wants to be in the business, and the other doesn't. We could issue two classes of stock. We'll give the one who will be involved in the business the voting stock, and the non-voting stock to the other son, the passive member. Bad idea. Why? Because first of all, these closely held businesses are not like publicly traded corporations in that they don't pay regular dividends to stockholders. So this passively involved son who only has non-voting stock, he'll get no income for it, his ownership. Secondly, he's not going to be able to sell it. Who would buy a passive interest in a business that pays no dividends? So he can't sell it. And thirdly, he's going to still have aggravation because he'll get pulled in dealing with tax issues, tax returns, banking matters. So he'll still be involved. He get nothing for it. Avoid passive interests. Use life insurance, as I'll explain, and I've already mentioned. Next slide. Okay. If we're giving away a business interest, we want to avoid gift tax. We have two tools to work with. First, the annual gift tax exclusion of $14,000 per year per person that you can give away. and the other is the gift tax applicable exclusion. Next slide. Here's how the annual gift tax exclusion works. Essentially, it's a simple rule that says you can give as many people as you want every year, $14,000 apiece, year after year, gift tax free. And if you're married, you can do what's called splitting gifts and give up to twice the amount, or $28,000 a year, to any individual you want, year after year. So, for example, if you've got a mother and father with 2 children, together they can give each child $28,000 a year, or a total of $56,000 a year, and do this year after year, gift tax free. So we can use this tool to give away business interest, gift tax free. Next slide. The other key tool is the $5.45 million gift tax applicable exclusion. This figure is tied into an inflation adjustment, so that next year it's going to be more than $5.45 million. But anyway, the point is this. Let's assume we've got a mother who's got a child that she wants to give $50,000 to. The first $14,000, assuming she's single, is gift tax free to the child based on the annual exclusion. The $36,000 excess, the mother can offset against her $5.45 million gift tax applicable exclusion and pay no gift tax whatsoever on the transfer. And she can do this year after year. Next slide. Okay, here's an example. Let's say you've got a situation where you've got customers who have a business they want to transfer to their children. In that situation, they should consider setting up a family limited partnership or limited liability company to which they transfer the business in return for these partnership shares. Let's assume they use a partnership approach. Now, in giving these gifts to the children, they can use their annual gift tax exclusion and their $5.45 million applicable exclusion. In doing this, they can take advantage of discounting for lack of marketability and lack of control. Now, what do I mean by that? Well, I mentioned earlier that my wife's parents, at my suggestion, were told to set up a family limited partnership and then to transfer their farm to the partnership in return for partnership shares, which were then given to the daughters. My wife has some of those shares. Anybody on this call care to buy one? I don't think so. Why? Because you're smart enough to know that you're buying an interest in a closely held business held by a family of which you're not a part. No one's going to pay attention to what you want. You have no control. Secondly, if you were foolish enough to buy one of the shares or partnership shares, who could you sell it to if you wanted to get rid of it? No one, except at a very steep discount. And for that reason, the courts have looked at this situation and said that these discounts are legitimate, they work, and they can be used. Next slide. Here's our example coming up. Let's assume we got a mother and father with 3 children and a business worth $20 million they want to transfer to the children. Now, without discounts, they can only give the children $10,984,000 in 1 year. That's comprised of $28,000 to each child, plus the parents using the $5.45 million gift tax applicable exclusions, totaling $10,984,000 gift tax free. But remember, we're not giving them an interest in a business directly. We're giving them an interest in a partnership that owns the business in the form of partnership shares. And we're going to assume that we can take a discount of 35%, which is about par for the course. So now, instead of giving the kids $10,984,000 in 1 year gift tax free, at a 35% discount, we can basically give them 1/3 more, or $16,898,462 worth of business gift tax free. By the simple technique of putting the business in a partnership and giving partnership shares, we just gave away 1/3 more of the business gift tax free. Is there a potential problem? Yes. Next slide. That potential problem is we said the business was worth $20 million. We just gave the kids about $16 million of that in 1 year. That leaves $4 million more. If the parents die before they give away the extra $4 million, they'll be exposed to tax. What can we do? Well, year after year going forward, the parents can use their annual exclusions and give each child $28,000 more of the partnership shares until it's all given away. But what if the parents die before they do that? There'll be a tax involved, an estate tax. So how to avoid that? Have the parents buy a term insurance policy that'll cover the period of time during which to make in the gifts. So if the parents die before all their shares are given away, and there's an estate tax exposure, the insurance will cover that tax. Next slide. I said before that beside making an outright gift to the kids, we can also make a gift to them in trust. And one way of doing that is called the GRAT. And here what happens is the parents set up a trust and they transfer the business to the trust. And the trust for the benefit of the children. While the parents retain the right to receive income, in our example, let's say for a period of years. At the end of that income period, the trust terminates and the business goes to the children. It's called remainder interest. Now, here's the thing. When the trust is set up and the business is transferred to the trust, at that point, the parents are deemed to have made a gift to the children of a remainder interest. The value of the remainder interest is determined using certain government discount rates. And if the business has been placed in the trust is producing a rate of return that's higher than the government discount rate, then we're going to get a break for gift tax purposes. Next slide. Here you can see how that works. Let's assume a father has a business and that he decides to give $1 million worth of stock from that business to his children in one of these trusts. But he retains the right to receive 4% of that every year, or $40,000 a year for 10 years. Now, using the government discount rates, that right to receive $40,000 a year for 10 years, the present value of that is $351,900, which means the balance of the $1 million of a stock he put in the trust is worth $648,100. That $648,100 is divided the remainder interest and the gift to the children at the time the trust is set up. Now let's suppose, though, that that company is successful and that stock pays a dividend of 7% a year. That means even after paying out $40,000 a year to the father, at the end of 10 years, that trust is going to have $1,423,983 as remaining interest going to the children. That is more than double the $648,100 we said the gift is worth when the trust was set up. So because it's a successful business, because rate of return was higher than the government discount rate, we got a real break in terms of gift tax exposure. Next slide. Is there a potential problem here? Yes. On 2036 of the code, anytime you give something away and retain a right to a benefit from it, that property comes back in your estate when you die. In this situation, father put $1 million worth of stock into a trust, retain a right to receive income from that trust for 10 years. If he dies in that 10-year period, $1 million comes back in his estate and could be exposed to estate tax. So what's the solution? The solution is that you buy a 10-year term policy in enough coverage to pay any estate tax that will happen if the father dies in the 10-year period. Next slide. This is, I think, the most powerful tool that exists for transferring really large amounts of wealth to the next generation, free of gift tax, free of estate tax. And it's called a seal to a grantor trust or installment seal to grantor trust. Well, the first question is, what's a grantor trust? A grantor trust is nothing more than an irrevocable trust set up by the client's lawyer that has one of three provisions. It can, one, purchase insurance on the grantor or their spouse, or two, can loan money to the grantor at interest but without collateral, or three, it can exchange assets with the grantor for assets of equal value. The implication of being a grantor trust is that for income tax purposes, we can ignore any transactions between the grantor and the trust. Okay, let's assume the lawyer set up a grantor trust with one of those three provisions. And we have this business we want to get in the hands of the kids. What the parents do is that they make a gift to this trust, what we call seed money, and they can avoid gift tax on that by using their $5.45 million applicable exclusion. So the first step is to make a gift of some liquid assets to the trust. Then they sell to the trust the business for a series of installment notes. And the rule of thumb is that for every dollar you give the trust as a gift, you can sell the trust $10 in assets. Now, why do we do this? We're doing this because we want to characterize this transaction, this transfer of the business to the kids, not as a gift, but as a sale. Now, yes, we're going to make a gift up front of seed money because we want to avoid the IRS saying that this is not a sale. Now, why would they do that? There have been cases where people have made a transfer to a trust for installment notes, knowing up front the business was not making enough money to pay off the installment notes. So the IRS said this wasn't really a sale because you knew that the trust could not pay off the notes. However, we've had the trust with a gift up front. Then the trust has both the gifted assets plus the business it's buying. And with that combination of assets, we feel secure that the IRS cannot attack it as being a gift rather than an actual sale. Okay, then with the money, the assets in the trust and the business in the gift, these installment notes are paid off over time. Next slide. Now, here are the advantages of this. First of all, if you've got a grantor trust, any income earned by the trust, and keep in mind the trust owns the business now, that income is going to be taxed to the grantor. So what does it mean? It means the assets inside the trust are growing income tax-free, and over time, that dramatically increases the amount of wealth we're transferring to the kids. Secondly, because the grantor is paying the trust taxes, those payments of tax in effect become gift tax-free gifts to the kids. Next, the assets, the business, and the future appreciation on it are removed from the parent's estate. And there's been no gift tax involved in the transaction. Next slide. Is there a potential problem? Yes. Remember, we sold the business to the trust for installment notes. What happens if the parents die before the notes are paid? The answer is that the installment notes are included in the parent's estate, and that might cause an estate tax exposure on the value of the notes. How do you solve the problem? Again, by a term insurance policy for the duration of notes. The parents die early, the insurance will pay the tax on the notes. Next slide. There is an alternative to using life insurance to cover any potential estate tax on any outstanding notes when the parents die, and that's called the skin. This is nothing more than, again, an installment sale situation, only this time, besides having the obligation of paying the installment notes, our buyer pays a premium for the right to cancel any outstanding notes that exist when the parent dies. So let's make a simple example. Let's say that a parent sells a business to a trust for the kids for $10 million. And the trust gives 10 notes of $1 million each to the parent. And let's say the parent dies in the 5th year. So we've got 5 notes of $1 million each outstanding. They would be included in the parent's estate, except that we're going to say up front when they structure the transaction, it was agreed that the trust will pay an extra $100,000 for the right to cancel any outstanding notes if the parents die early. So in our situation, the sales price is $10 million plus $100,000 for the cancellation right. And if the parent dies in the 5th year, the remaining 5 notes are not payable. They're not including the estate, no estate tax exposure on that. Next slide. Buy and sell agreements. This is a very, very useful and effective tool for transferring business interest to the next generation. Now, we typically want to fund these types of buy and sell arrangements with a life insurance policy. And the first thing to do is realize that if the sale takes place during life, such as on a parent's retirement, we haven't got the death proceeds to cover the price. So what can you do? The answer is that we can touch the cash value of the policy as a down payment. And the more cash you get up front, the better. So we give the cash value of the policy as a down payment and the rest of the sales price in the form of installment notes. And then if the parent lives, and eventually dies, we collect the death benefit and pay for the business that way. Caution. Sometimes people set up a buy and sell agreement and they fail to pay attention to monitoring the insurance after that. Here's a case I had in the Pittsburgh area. 2 brothers started a bar restaurant business. Starting out, they were not well off. So fortunately, with the lawyer's advice, they did create a buy and sell agreement. and each of them bought $10,000 insurance on the other because that's all they could afford. Well, the business took off. Very successful, but sadly, at 48 years of age, one of the brothers died. Anybody want to make a guess as to how much his widow got? The answer was $10,000, the original amount of insurance. His interest was worth far more than that. But because they didn't pay attention to monitoring the situation, the value of the business outstripped the insurance amount, and the widow was hurt by it. I've learned one thing over the years, and that is that in these situations, while it's true that blood is thicker than water, I've always learned that cash is thicker than blood. Pay attention to the amount of insurance. Make sure it keeps up with the value of the business. Next slide. Locating prospects. So where do you find people that you can deal with in this marketing opportunity? First of all, look at your current book of business. Do any of your current customers own a business with a succession problem? Ask them about it, work with them to create a succession plan. Next thing, keep in mind that various business groups out there, like the Chamber of Commerce or Rotary Club, whatever, they typically have monthly meetings, and they're looking for people to speak to them about subjects of interest. One strong subject, of course, is business succession planning. You might want to team up with a lawyer or accountant to make a presentation to them. Next thing, think about jointly marketing with agents who specialize in group insurance or pension work, because they're going to be very much involved in dealing with business people. And finally, and easily overlooked, approach business owners that you yourself patronize. Give you an example. I knew a guy who was an insurance agent. Starting out, was very ambitious, very hardworking, and he was working himself about half to death. But he wasn't making as much money as he wanted. So one day he's standing outside of a car wash waiting for his car to come out, and he suddenly realizes that every time a car comes out of that car wash, it's like $15, $20. And he knows that he can't work any harder in terms of how many applications he's taking in a week. So if I can't make any more money by taking more applications, I've got to take bigger applications. Who's got that kind of money? You realize the guy that owns his car wash has got it. Looking down the street, there's a restaurant with people standing in line. You know, there's a travel agency. You know, there's a gas station. All these business people around him had the wealth and the need for his kind of service. And he then approached them and was quite successful in their business succession planning market, selling life insurance for the 5 kinds of needs I've described. That completes my formal presentation. I welcome your questions.
Just a reminder to all our listeners that if you do have any questions, please use the Q&A feature on the bar. Lou, it looks like we got a question.
Okay.
It's asked by John. Hypothetically, assume 7702 proposal goes through, what strategies do you think are used more?
You mean 2704, that provision?
Yeah, 2704. He just corrected it.
Okay. I'll repeat what I said before. Number one, this is not going to take effect until after the first year. And at this point, we're not even sure what it means. There was some speculation that it would have a dramatic effect and eliminate discounts. Others say, no, that's not the case. There was a presentation by an IRS official at an industry meeting that indicated that it's not what people think it is. Anyway, I would say to you that even if it would take effect to have a detrimental effect on discounting, I think it's probably true the Trump administration is going to kill it. But here's something else I want to emphasize to you. Even if you were to take away the discounting aspect of this gifting approach, it is still something people should do, because you've got a business, you're going to die, retire, become disabled. You need a plan for transferring that business, in many cases, to the next generation. In our situation, the farmer I described, setting up a family limited partnership, not only did the transfer of the shares to the girls eliminate estate tax exposure, it also gave us an ownership structure, a management structure for running that farm. And that's what's been operating for the last 15 years. So it's not just taxing you think about, it's also how we can run this business and what structure is appropriate to that. In our particular situation, we took a family partnership. It could have been a limited liability company. It could have been a corporation. There are a variety of ways of skinning the cat. All that discounting does for minority interest and for lack of control and marketability, all that does is make the gift tax exposure smaller or non-existent. So the key here is to have a plan to transfer the business. And if you do it the right way, you're probably going to get discounts on the gifting. And if you don't, it's still worth doing. Again, for the management reasons. Does that answer the question?
It looks like there's another question from, oh, John said yes, that did answer it, and he said thank you.
Okay.
Michael has a question for you. He asks, how would you open this discussion with a business owner, client or not?
Oh, I love this question. This is the one that people don't talk about, and boy, they should, because, you know, if you're going to open a conversation, you have to have a place to start. And here's my suggestion to you. I'm going to tell you a story. My former consulting partner and I had made a presentation to a group of agents in Houston, Texas. Sometime thereafter, one of these people who was in the program, the training program, had a father who was a wealthy man and made some calls to friends of his who were wealthy people trying to help his son set up appointments. Well, one of these guys was worth $100 million and said, okay, I'll see your son because he's your son. Now, the young man was new to the business, but he was no fool. He didn't have, in his own estimate, the kind of sophistication to walk in the aisle. A man who's worth $100 million, not knowing what you're going to be talking about. So he grabbed my consulting partner who was in town, Denny, along with another fellow, Sam, who was a valuation expert, and they go to see Mr. 100 Million. The rest loaded up to the top of the skyscraper. They're taken into the boardroom, and they're sitting there, the three of them. In walks Mr. 100 Million, takes one look at Denny because he's got the gray hair and says, "You've got 30 minutes of my time." Now, I submit to you that many people in that kind of a situation might panic. Put simply, this is not the time when you whip out your fact finder, because that's not going to work. Denny is a cool head, been around a long time. He looks back at this guy and he says, okay, now let me ask you, where are you in your planning and where would you like to be? That 30 minutes turned to an hour and 30 minutes, an ESOP sale. The man's answer was that, actually, I've done no planning, but I attribute my success to my good employees. I want them to have this business eventually, and a way to do that, ultimately, as I said, was a ESOP. So my suggestion is this. You say to somebody, where are you in your planning? Where would you like to be? You're not even asking what kind of planning. You're putting in their court the choice of where to go. And in his case, it was, business succession planning. Alternatively, you might say to them, would you like your business to go to the government for taxes, to a member of your family? Or would you like to be in business with your partner's wife? Another approach of disturbing them. But I really like the one about where are you in your planning and where would you like to be? Now, one thing I'll tell you, I mentioned fact finders. You don't know where this person's going to go once you ask that question. And you need to do your homework and study fact finders for business succession planning or estate planning or whatever, so you know the right kind of questions to ask once they pick the direction they're going to go. Okay?
Well, that looks like that's all the questions for today. Thanks, Lou. Again, all the information you talked about was very informative. If anyone has any additional questions for Lou later on or for AALU in general, please feel free to email communications@aalu.org. Also, a copy of the recording will be sent around shortly after this. So thanks for tuning in and happy holidays.
Bye, everybody.